Today's video looks at 5 ways that inflation will impact your wealth. Number 1, let's get right into it. Inflation will likely hammer growth stocks in your portfolio. If you have growth stocks in your portfolio that are trading at a very, very high price to earnings ratio, any tech company, any companies that don't have earnings yet, that are trading on a multiple of sales, they're getting hammered. And why are they getting hammered? You have to discount the value of the inflation towards the long tail end of the growth stocks. Most of these growth stocks are not projected to make money for 5 or 8 or 10 or 12, 15 years. Some of them, the net present value of the company is in a long, long time, and that needs to be discounted now by a lot more, meaning that it's worth less. Therefore, these growth stocks get hammered. Anything that's trading at a high multiple gets hammered. Depending how much of that you have in your portfolio, high inflation, not good. Because remember, inflation is a force. It's an insidious force that attacks. Why? Because it erodes the value of your dollar, on your purchasing power of your dollar year over year. Remember that inflation is the increase in the price or the cost of a basket of goods year over year. Equally, it could also be defined as the reduction in purchasing power of your dollar year over year. If your dollar last year could buy 100 widgets, maybe it can only buy 98 widgets this year. So it's been eroded. The purchasing power of your dollar has been eroded. Number 2, inflation has improved or increased the value of your real assets. Now, what are your real assets? You might have real estate. If you own your home, if you own a condo, if you own private real estate through your portfolio, if you own private infrastructure, anything that's real assets, that has increased in value, and that is expected to do well in an inflationary environment. Now, why is that the case? Because if you have real assets, such as real estate, you are collecting rent, right? You're collecting rent, and that's how the value of your real estate gets measured. If you're collecting more rent because of inflation, what does that do to the value of your real estate? Your real estate goes up. If you're able to collect 7% more rent this year than last, which is what inflation is, an increase in rent, your building is likely worth 7% more, maybe less, but it's likely worth a lot more. So real assets are a great hedge against inflation. And it's not just real estate, infrastructure. It could also be commodities such as gold and metals and mining. And not just that, but you could also have in there collectibles, art, hockey cards, Magic the Gathering collector cards. And if you have any collectibles such as signed sports memorabilia or signed historical documentation or artwork or stuff like that, that stuff also increases in value with inflation, because inflation is too many dollars chasing too few goods. So if there's only one Babe Ruth signed ball and there's a lot of dollars that are chasing it, what's going to happen to that ball? It's going to increase in value. So inflation causes the real assets to increase in value because there's less of them and there's way more dollars that are chasing those same goods. If you're not able to produce more of them and you have the same amount of dollars that are chasing them, it's not going to increase. But if you have more dollars chasing them, then you get an increase in real goods. Number 3, you're likely going to see an increase in interest rates. Inflation is typically fought with an increase in interest rates. So central banks have at their disposal power and the ability to do a few things. But 1 is to reduce the monetary supply. 2 is to stop the capital injection in the capital markets or the bond buying program. And 3, the big one, is to increase interest rates with the idea that you would slow down the economy, you would force businesses and consumers to save more and spend less and bring the prices down. So if you have a portfolio that's long on bonds, I would be careful in an inflationary environment because you're likely to see interest rates go up, which means bonds go down. In a situation where interest rates go up, and if you have guaranteed investment certificates or bonds, their value is less in a rising interest rate environment. You need to diversify. You cannot own long bonds in an inflationary environment. It's very, very dangerous for you, or at least you need to diversify. Number 4, stocks do not always decline in times of inflation. So we talked about how growth stocks are likely to decline, but I really need to beat this point home. Stocks can do quite well in periods of inflation. Why? Because companies have pricing power and they're able to pass that on to you, the consumer. So if I'm in healthcare, or if I'm in retail, or if I'm selling products of some sort and there's inflation, I can typically pass that on to you and I can collect more profit and more revenue. And therefore my company could still be worth the same or an increase year over year. So inflation doesn't necessarily mean a reduction in the stock market. Now, hyperinflation coupled with hyper interest rate risks, coupled with a significant reduction in spending, coupled with unemployment, all those together can be bad for the stock market. But just inflation doesn't necessarily mean that the stock market is going to crater or tank. Number 5, diversification is always the key here, because we talked about what can happen to an inflationary environment, to your wealth in an inflationary environment. You're likely going to pay more on your mortgage because interest rates are going to go up. You're likely going to get hammered on your growth stocks. You're likely going to get an increase in the value of your real estate, your home, your condos, whatever you own there. You're likely going to get an increase in the value of some real assets that you own. And you might see an increase in the value of your stock portfolio. You're going to see a decrease in the value of your fixed income portfolio. What does this all mean? Diversification. You should not own exclusively commodities. You should not own exclusively real property, because there are different cycles where each of those will perform better than others. And true diversification is when asset classes don't move in unison, right? You have one asset class that does well in an inflationary environment, one that does well in a deflationary environment, some that do well with growth and some that do well without growth. The key is that your portfolio is always moving upwards, or at least long-term, it will trend towards moving upwards. If you have nothing but one specific sector or one specific exposure to your portfolio, that's not true diversification. That's why we always preach here at the Tetrault Group, you should own alternatives in your portfolio. You should have private real estate. You should have private infrastructure, private equity, private debt, farmland, music royalties. These are all asset classes that are uncorrelated to the stock market that typically perform well and can perform quite well in an inflationary environment. We've been saying this for years. Check out the videos that we posted years ago. By the way, while you're here, take a sec to like, follow, give us a subscribe. We'd love to hear your comments on this video. But I've said it before and I'm saying again, if you own a traditional 60-40 stock portfolio, you think you're diversified, 60% stocks, 40% bonds, you're not. Typically, your stocks and bonds in the last 10 and 15 years have moved together, going down together and going up together. That's why we've always said it's important to have that third asset class. And it's really important to look at why you own fixed income. Make sure you understand it, because in a rising interest rate environment, it can be very dangerous. All right, guys, thanks for tuning in. If you'd like to book a no obligation consultation to chat about inflation, interest rates, all this, how this can impact your portfolio, please go to www.speaktorob.com. I'd love to book that chat with you to chat about this, your portfolio, your investment strategy, your retirement, whatever's on your mind, guys. Thanks for taking the time today. Don't forget to like, follow, subscribe, and I will see you in the next video.